Hello, and thank you for joining us. I'm Callie Breeze, and on behalf of Thrivent and our financial advisors, it is my pleasure to welcome you to this Market and Economic Update. Whether you're watching this live or a recording, we hope our time together gives you insights into what's going on in the economy and the markets. Our topics today are guided by your pre-submitted questions. We're going to talk about the latest on the economy, including inflation, employment, and recent market performance. And we'll touch on the geopolitical environment globally and something that was on the minds of many clients, the potential market and economic implications of the presidential election. We'll have live Q&A for the last 15 minutes of our session. If you have a question, you can type it into the Q&A box at the bottom of the Zoom screen. We also have a glossary of terms available for you. As always, we are going to cover a lot of ground, so we recommend connecting with your financial advisor to see how the information discussed today relates to your personal financial strategy. So let's turn to our panel. I am joined today by David Royal, Chief Financial and Investment Officer, Steve Lowe, Chief Investment Strategist, and Tracy Pamperl, Director of Investment Grade Research at Thrivent. Thank you all so much for being here.
It's great to be here.
David, would you like to take a minute and introduce our guest? I
always love to, and longtime viewers will remember Steve Lowe, but I love to review his bio because it's impressive. Steve started on the equity side, picking stocks early in his career, and then was our head of fixed income for many years, and now oversees our kind of global macro asset allocation strategy, particularly for our asset allocation fund. So great to have you here, Steve.
Thank you.
And Tracy Pamperl, our head of investment grade bond research. I think as we start talking about the economy and the markets, it'll become clear very quickly why we thought investment grade bonds would be a great topic for today. So thanks for coming.
Thanks for having me.
Wonderful. Well, we are going to start with a question for you, David, kind of at this macroeconomic level. Your slow takeoff analogy, the idea that the economy, rather than heading for a soft landing, might actually be on a takeoff trajectory, it has fared quite well for the past couple of years. As we get started today, I'd love to hear what you're seeing right now on this flight.
Sure. Thrivent was a bit of an outlier in 2023 going into 2024 because we weren't anticipating a recession. Most of Wall Street was. And I felt the economy had enough momentum coming out of the COVID reopening. Viewers will remember my little Christmas ornament from the royal family tree, the little airplane. I felt like we continued that slow takeoff. When you first take off an airplane, you go up very quickly, and then you keep going up more slowly. But then eventually you reach what the pilot might call the cruising altitude. And as the pilot says, it's okay to walk around the cabin, but keep your seatbelt fastened in case of some unexpected turbulence. So, as we're going to talk about today, the economy is solid, but we're seeing signs of it slowing. All the while, the market has hit new highs, and I think that's a recipe for some volatility. This is a time, in my view, to stick pretty close to your long-term allocations. We're neutral on stocks overall. We have some overweights and underweights that Steve and Tracy and I will talk about. But I wouldn't recommend getting too overweight risk right now. And recall, I've been the most optimistic one. You might see a little role reversal with me and Steve today. But I'm becoming a little more cautious, although still optimistic. Bonds in this environment offer some very attractive yields, but you have to be mindful of the risk you're taking with different types of bonds. And that's why I thought it would be so helpful to have Tracy here today.
Yeah, I really like that flying analogy. We've had a strong tailwind post-pandemic with renormalization and a lot of stimulus money, but now we've had headwinds for a bit with higher rates and a little bit rough weather ahead probably, but I think we get smooth flying after that.
Well, I like that the analogy holds. So Tracy, as David mentioned, we are so glad to have you here. You're going to be talking about bonds, throughout our conversation. Ahead of that, I would love to just have you demystify bonds a little bit for us. Maybe tell us first, what is a bond? What are the different types of bonds? And then how are they classified?
Sure, I'm happy to be here. So first, what is a bond? It's really just simply a loan to a government or a corporation. It typically has a defined maturity date, when that bond will finally term out, so 5, 10, 30 years from now. You collect interest payments along the way. And if you hold your money to that maturity date, to that end date, you get your full investment back. Different types of bonds, we typically do it by asset class. So at a high level, it would be government bonds, municipal bonds, and corporate bonds. And we classify them in a handful of different ways. Some of the most typical ways, the first one's by ratings. So ratings categories, the highest rating would be a triple A, the lowest would be a C. There's several rating categories in between, and there's a differentiation in those rating categories which would define an investment grade and a high yield bond. So investment grade would be our triple Bs all the way up to our triple As. And then high yield is our double Bs and below, and there's a definition of risk in there. So, investment grade would be a bit safer, high yield a bit
High yield
riskier.
are sometimes referred to as junk bonds.
Yes.
Yep.
Okay.
Yeah, exactly. Another classification is country of risk. So where the company does a majority of its business or majority of its revenue comes from. So that would be country of risk: U.S., Canada, Japan, United Kingdom. And then within corporate bonds, we also do a classification at the sector level. So some of those higher ones that you may be familiar with would be banks, technology, and transportation.
Yeah, I think another important attribute of a bond is that it's senior in a capital structure. In other words, how companies fund themselves. So in the event a company goes bankrupt and in default, then you get paid out before there's anything left over for the equity holders, who own the stock. And it's not really that dissimilar from a bank mortgage, right? If you default on, your mortgage payment, they get to seize the house and take that as collateral. So the point is that they're relatively safer than equity.
Yep.
Yeah.
Great analogy. Speaking of, David gave that great macroeconomic overview and talked about turbulence. It feels a little bit kind of out there, that there's a feeling of waiting for something to break. Is that real?
Yes, I think a lot of people were waiting for something to break. Especially economists had predicted a recession. We haven't had one. And the reason why is it often happens when the Fed raises interest rates. Higher borrowing costs stress an economy. And you saw that happen in the financial crisis when there was a housing bubble. One of the reasons that it popped eventually was higher interest rates. And we've had pockets of stress now. Commercial real estate is one of them. Part of that is pandemic related. The other part is that rates are higher. And in 2023, we had banking issues directly related to higher rates. Silicon Valley failed and some other banks. But we haven't had a systemic breakdown this cycle across the economy, nor have we had that predicted recession. There's always uncertainty in markets and the economy. It's just something as an investor you learn to live with and you deal with and analyze. But since the pandemic, I think has been particularly high because we haven't been through this before. We haven't had a pandemic, and this economic cycle just feels different. But the good news is the uncertainty started to decline, and I think the odds of like a big systemic issue, a breakdown, is lower. Inflation is slowing. The Fed appears to be ready to cut rates. The consumer is holding up well. The data's a little mixed, but they're still spending, and retail sales have been strong. The labor market is slowing, but we're still producing jobs at a good clip. And company earnings are very healthy right now. So the economy has performed better than expected. And the consensus now has flipped from a recession to no recession. And, there's still a risk. Higher rates take a long time to impact an economy. We've talked about that before. It's like over a year or 2 years. But the other issue is that, economies can decline quickly. In other words, you can start slowing, then, it starts building on itself and suddenly goes down very, very rapidly. So that's something that we're watching for, but not our base case. So we expect turbulence, but, we're still airborne. We're still at cruising altitude.
I'm sensing some of that optimism coming through. We want to take our first poll question here with the audience. We're going to talk about the consumer broadly in a minute. But we want to know, along those same lines, what is most weighing on your mind presently? You have a couple of options. One, inflation and high prices, employment changes or uncertainty. Maybe it's the housing market, certainly the upcoming election, broader international geopolitical events, or maybe it's number 6, something else. While you are plugging in your answers there, we are going to turn to David and Tracy. Again, I've heard you all talk in the past about the importance of the consumer, really as kind of the lifeblood of the economy. Would love to know, one, how they're feeling, but then also how, data suggests they're doing.
Sure, and I've talked about productivity before, but I think it continues to be an important consideration for the economy. But overall, consumers are just a little bit grumpy, I would say. And that's driven by inflation, both price levels, even as inflation comes down, and just people, what they're seeing in their daily lives in terms of the price of food, gas, energy, and so forth. But it's important to dig into the consumer confidence numbers a little bit. There's two major surveys, the University of Michigan and the Conference Board. And what we see is that consumers are pretty positive about their current economic conditions, but they're much less optimistic about the economy in the future. And some of this is probably uncertainty around the upcoming election. I'm sure we'll talk about that a little bit.
Yeah, we are going to come back to that.
But people see signs of a slowing economy in their daily lives, both as workers and as consumers. So maybe their company hasn't let anyone go, but it's not hiring quite as aggressively as it used to be. So consumers' views make sense in terms of the overall macroeconomic environment, where we have a solid economy, but with some signs of slowing. And this aligns with the overall macroeconomic environment in the yield curve. This is the unusual situation where short-term rates are higher than long-term rates because the Fed has raised rates to slow the economy, and the expectation is that would result in a slower economy in the future, which is why we have lower long-term rates. So what consumers are seeing kind of makes sense.
You mentioned the University of Michigan survey, and there's an interesting data point out of there that shows consumers are very unsettled. About 50% think they're worse off than they were a year ago. And the main reason is higher prices. Even though the inflation rate has slowed, prices are still very high, and that's stressing budgets.
Tracy, what are you seeing?
Yeah, so from the credit analyst side, how we get our information is at the company level. So right now we're in the middle of earnings season, so we're getting that information kind of real time at this point. That information we're gathering suggests that the consumer is in a still pretty good financial position and willing to spend. But I would call it with a bit more caution because there is a sensitivity to the higher prices of goods and services that we've been mentioning and some uncertainty about the future. So some examples I would give of what we're hearing, consumers eating out at restaurants a little bit less and eating at home a little bit more. Trading down, so trading down to lower price goods or that generic store brand instead of that name branded good when you're at a store shopping is another way we're seeing it. And companies are seeing that as well. So what we're really seeing is they're responding to this, and promotional activity has been picking up a lot. And the example that I think of that's really timely is McDonald's just reintroduced the $5 meal.
Yes, it's back.
A lot of other restaurants followed with their own value meals, right?
Exactly. So they're responding to what they're seeing in the consumer as well. So again, overall, I think the consumer is in still a relatively healthy position, showing a willingness to spend. I just think they're having to think about how, when, and where to spend their money.
All right. Well, let's get the answers to our first poll question. It looks like we've got election in at number one, 41%. 36% of you followed up right after that with inflation. Geopolitical at 13%. And then housing, employment, and other were at 6, 3, and 2. So really kind of that.
Not a big surprise, kind of in line with the surveys we're seeing.
Yeah, the surveys show that people are very apprehensive about this fall, and that's showing up in consumer confidence surveys.
About the future, the longer term, and as well as inflation. So it makes a lot of sense.
It does to me too. Okay, Steve, let's talk a little bit kind of again, staying in the mindset of the consumer. Inflation versus deflation. Are we likely to see, a deflationary or disinflationary environment? And, what would that mean if we did? Would it be good or bad?
Deflation is bad if it's broad across the economy. The good news is that we're seeing inflation slow, and there is deflation in areas. Certain things like car prices are actually falling because they shot up during the pandemic. I think it might help to take a moment just to kind of explain inflation. Consumers define inflation very differently than investors and economists do. They see inflation as the level of prices, and they see it over a change of a few years, and especially relative to the money that they make, the pay they're taking home. And what inflation is the rate of change. So we look at month over month or year over year, our price is higher. And deflation, as mentioned, is when prices actually fall. The trends are actually very encouraging. So price increases have slowed in most categories. So the inflation rate is easing, it's coming down. And many goods in particular are in deflation. And what's behind this is that demand has tempered a little bit, it's slowed. And those production capacity strains and shortages that were prevalent at the height of the pandemic have pretty much completely eased or mostly eased. And this is really positive because it opens up the door for the Federal Reserve to cut interest rates, and that should help consumers and that should help the economy. While low prices can be good, it's nice
Feels
when
good,
prices
yeah.
fall. Broad deflation, as I mentioned, is not good for an economy and especially not good for debtors. So let's just say I decide to start a widget factory, I go out and borrow $1 million, and then prices start falling. So we're in a period of deflation. Well, my sales will fall, but the amount I owe the bank is still $1 million. Sure. So it makes it really hard to do debt repayment and much more expensive, and that discourages investment. It has a very negative effect on an economy.
Thank you. Tracy, how are bonds performing in this interest rate and economic environment?
Yeah, sure. So I'm going to take it from the corporate bond side and just give a little bit of a definition. So a corporate bond has a spread on top of the corresponding U.S. Treasury. So it adds additional yield. And the reason you need that additional corporate spread is for the risk, relatively small, but for the risk that a company may file for bankruptcy and may not be able to pay you back. With elevated Treasury yields right now, investment grade bonds have their strongest yield, the most attractive yields they've had in almost 15 years. So that's very attractive for investors at this point. But it's also resulted in very, very strong demand and has been driving those corporate spreads even tighter. So the counter to that attractive bond yield is that credit spread is actually near historical tights. So what that means is, you're not fully getting maybe paid for the risk at this point. So to us right now, selecting the best companies is absolutely crucial.
And bonds broadly, and particularly treasuries, have this tailwind of lower rates, right? Which, lower interest rate works to increase prices of bonds. And it's really not dissimilar if you think about mortgage rates. When they're high, what you can afford in houses, that pushes the price of houses down. And when they're low, housing prices can go up.
That's again another great point there illustrating. We are going to talk about the Federal Reserve next, but we want to hear from you about the role that interest rates might be factoring into purchases for you. So 3 options. Are they factoring into purchase decisions? 1 is yes. 2, only on significant purchases, maybe like a home or a car. 3rd option is no. While you plug those in, we are going to talk about the Fed. Steve, the Fed whisperer. They have been in a watch and see mode all of 2024. And in fact, I think almost a full year since the last time they raised rates was in July of 23. What are they watching for, and maybe what are they seeing?
Yeah, we've been talking about the Fed a lot lately because it's very important for the economy and in defeating inflation. So what they're watching for is inflation to come down sustainably from high levels. They want it to go toward their 2% goal. And they're watching for when they can start cutting rates without inflation reigniting. So the concern is that you cut rates and then inflation goes up and you have to come back and raise rates again. It's been a bumpy path, but we're seeing substantial and encouraging signs on inflation. And they're also watching the jobs market. So the Fed has 2 mandates given to them by Congress. One is price stability, that's inflation. The other is maximum employment, that's jobs. So they're watching this second part of their mandate now. And job growth is slowing, but it's still really solid. The economy is producing jobs. But the concern is that you have low but rising unemployment. And the concern is that it will keep rising. Because once unemployment goes up by about 0.5 percentage point, typically it keeps going up and it keeps rising. And the reason for that is, if you think about it, if one company cuts back, they have suppliers and they're cutting back on that, and then those suppliers have less business and they cut back, and this kind of snowballs through the whole economy. So I think the key development lately is that there was this imbalance in the Fed's mandate, and it leaned heavily toward inflation. They raised rates really high to kill inflation. And now it's more balanced because inflation is down and unemployment is starting to rise. So they're starting to pay a lot more attention to the unemployment rate. And we think the Fed is ready to cut soon, September most likely, maybe November, for the start. And they appear a lot more confident that inflation will come down. They have this prize insight that we've been talking about, the softer or no landing, and they really don't want to mess it up by waiting too long to lower rates, because if the rates are too high for too long, that could trigger a recession and higher unemployment.
Yeah, the market's pricing in a nearly 100% chance of a rate cut in September, and that September meeting is September 18th on the 20th anniversary for me and my lovely wife. So we'll get a little gift from the
That's exciting.
Fed.
Do you think that will be the gift?
I better come up with something more than that.
What better gift, right?
Do they make a card for that? That's what I want to know, yeah. Well, David, Steve talked about labor and employment. I know that's something you watch really closely.
I do.
I would really like to hear what you're seeing across employment, productivity, and also wages.
Sure, we've talked about this before. I'll start with productivity. It's a favorite topic of mine, as you know. It's improved meaningfully over the past year. I mentioned before that there was a post-COVID decline in productivity. As the economy reopened, there was a shift from goods production to services, and it's harder to make productivity gains in the service sector. So the question was, would productivity improve and normalize as the economy normalized? And the good news is it has, or it seems to have. I don't think it's AI or artificial intelligence yet, but I think we'll see some productivity gains in the future from that. But employment remains historically strong, but we're seeing some signs of weakening. In real time, we see weekly jobless claims every Thursday morning. Those have ticked up a little bit. The unemployment rate has ticked up a few tenths. Job openings peaked at about 2 openings per unemployed worker. That's down to about 1.2. We actually got new data earlier this morning, right before we went live, similar to prior months. And this can cause, as Steve mentioned earlier, unemployment to jump suddenly sometimes, because as long as you have more job openings than unemployed, if someone loses a job, they tend to find one pretty quickly. But once that ratio goes below 1 to 1, someone loses their job, it's much harder for them to find a new job. And that's what can cause this sort of non-linear jump in the unemployment rate. Once it starts to go up, it can go up pretty quickly. So that's certainly something we're keeping an eye on.
What I was going to add to that is, when we're listening to our companies, 18 months ago or so, trying to find, qualified workers was very, very hard. They were having to, raise prices, but it was just very hard to find those.
Yeah.
It was a very hot topic. It's not even discussed anymore.
Yeah, that's interesting.
And that's a big positive, because one of the main concerns of the Fed was that the shortage of workers would push up wages, and that would fuel inflation.
Yeah. Well, speaking of wages, I would call out that the other thing I've harped on a lot is real wages, which is the amount of money people make minus inflation. And those have been positive on a year-over-year basis for over a year now. They turned positive last June. And this is due to the decline in inflation. This is probably the metric, one of the metrics I watch most closely, because this is what American families are feeling. Can you afford more or less than last year? And the news has been pretty positive on this front.
Yeah, I think your comments on artificial intelligence are interesting.
Yeah.
Because typically you look at new technologies, it takes 10, 15 years, and I think it'll take time for AI to kind of penetrate the economy. But Indeed, job postings for software developers are down 50% already, because you can use artificial intelligence to do coding for you.
Absolutely.
And if AI doesn't improve productivity, that can help drive real wages, because you can have higher wages without driving inflation if workers are more
And
productive.
ideally you want wages above inflation because of productivity.
And that helps with the deflation, I'm assuming, eliminating some of that pain point there too. Well, let's hear your answers. 51% of you said that interest rates are impacting your significant purchases. 17% of you said yes, it's affecting your purchases across the board, and 33% of you said no, it was not. So thank you for those real-time insights from you. We're going to shift a little bit and ask a question that's on the minds of our audience. But I'm going to do it cautiously, David, and I know that you're going to answer thoughtfully, as you always do. The election, it is looming, larger and larger, it seems. Would love to know the role that maybe elections have historically had in the economy and markets, and then what the markets are anticipating currently.
Sure. Now, every election is really important for our country, but they don't tend to move markets as much as a lot of people might think. Markets are more driven by corporate earnings, interest rates, a lot of the macroeconomic stuff we're talking about, employment, productivity. And despite the extreme political polarization, the parties have more in common economically than maybe in some prior years. Neither party is running on a platform of reducing the federal debt or deficit. They have some differences around specific tariffs, but neither party is advocating for free trade as some have in the past. So the market is anticipating probably somewhat higher long-term rates, again, driven by higher deficits and growing national debt. There certainly are specific industries that would benefit from one party or another. Green energy would benefit from a Democratic administration. You'd probably see more merger and acquisition activity under a Republican administration. That's been curtailed more recently, and that would help financial services, investment banks. Oil or traditional energy are kind of interesting because on the one hand, Republican administration might allow more drilling, but that could bring prices down, whereas a Democratic administration that might allow less drilling could actually drive prices higher. So it's not 100% clear which would be better for oil companies. I guess the last point I would make, and Steve and I have talked about this a lot lately, if you look at the data around do markets perform better in Democratic or Republican administrations, it's really kind of a wash. You can slice the data different ways, but they don't perform dramatically better under one party or another, which is another reason why just stay focused on corporate earnings in the economy, because that's what's going to drive the market.
Great points. Looking maybe a little more broadly, Steve, how is the international geopolitical and economic environment looking?
Very interesting. There's this adage that there are decades where nothing happens and days where decades happen. And the environment to me feels a little bit like that a lot could happen all at once, sort of. And geopolitically, I'd say the environment is simmering and reaching a boiling point, potential to boil over. And by some accounts, it's the most dangerous geopolitical environment since right before World War II. You have active wars in the Mideast, in Gaza, threatening to go into Lebanon, and in the Red Sea. People are targeting shipping and sinking oil tankers and other ships. And we're locked in this kind of long-term strategic rivalry with China, with Taiwan as a potential flashpoint. Don't forget there's a nuclear-armed North Korea that is posturing pretty aggressively recently. Iran is developing nuclear weapons too, and kind of fomenting insurgencies around the world. And then there's coups in Africa and elsewhere. So there's a lot going on.
Yeah.
I think the big picture is that we live in a multipolar world now, and that's more risky. Because previously you had the superpowers kind of tamp down everything. There was, the Soviet Union and the United States, and they kept a lid on everything. And then the United States was the dominant power. And now is, more multipolar. So we would expect a little more conflict. All that said, geopolitical events really don't affect markets over time. That's exactly what happened when Russia invaded Ukraine. Markets reacted, and then they normalized again. And that happened even in World War II. Markets still did well in the U.S. over time. Looking at the global economy, it's a very varied right now. The U.S. is a standout, particularly among developed countries. It's had very strong growth, steady growth. And Europe has a really anemic growth for a while now. Manufacturing has been in contraction for about 2 years now. And their long-term challenges, they have lower productivity, heavy regulation, and their population is shrinking. The same thing for China, their population is shrinking. And their growth has slowed materially from what it was, and their housing market has collapsed, and that's a big issue for people who had all their life savings in that. And they're having a lot of trouble getting domestic growth going. So what that means is they're pivoting more to manufacturing, and they're pivoting to export, and that creates trade frictions. And I think trade frictions are likely to grow no matter what happens, with the U.S. election. And you're going to see, maybe tariffs on China, potentially Europe, and more decoupling of economies. And global trade is good. It actually increases growth overall. So the takeaway is expect more turbulence.
Okay.
And I think that's important, your points about trade too, because we're going to hear a lot about trade in the election, but it's driven as much by macroeconomic factors as it is by the fact that it's being discussed in the context of an election.
Great point. Tracy, we're going to talk about asset classes in a minute, but before we do that, would you just tell us a little bit about the role that bonds can play in a portfolio, and maybe in a portfolio in this market environment?
Yeah, so the first thing I would say is I think it adds some really nice diversification into a broader investment portfolio. I think Steve may have touched on it earlier that they also are a bit more stable, and that's because you're going to get an interest payment in typically twice a year. There's a very high likelihood you'll get your full investment back at the end if you hold the bond to maturity. And you can make those choices of what companies to invest in. So I also mentioned earlier there's that additional spread over a treasury, so it adds a bit more income as well. We've also seen, the yields right now on bonds are some of the highest yields we've seen in a very long time. So I actually think right now it's actually a pretty attractive alternative into a portfolio than it has been in the more recent past.
Yeah, and you see really strong demand because the yields are, like you mentioned, the highest really since back to almost the 1980s.
All right, so let's do that review on the asset classes and some general positioning. David, I'll start with you with equities.
Sure. I think we're going to see some broadening of the market beyond the magnificent 7, 6, 5, however many it is, but the large cap tech stocks. And I think this is because declining rates can help smaller companies more. They have more debt. It tends to be shorter term debt. It's often bank debt. So they maybe didn't have the opportunity to refinance and lock in really low rates in the bond market a couple years ago. Big tech companies, by contrast, hold a lot of cash. And they don't have as much debt, so they can actually benefit from higher rates. It's very different than tech companies in 1999 or 2000 or something. So, we're sticking to our long-term equity allocation. We've actually trimmed our overweight a little bit. And I might think about adding some smaller company names. I mean, I've talked about smaller companies the last couple of quarters. I think they'll thrive if rates come down for some of the reasons I just mentioned, especially if the economy remains strong. And I know that's a bit of an if. So another underappreciated aspect of investing, too, I think, is if you're going to add maybe some small company stocks, which are a little riskier, is to think about the sizing of those bets. When small companies run, they tend to run quickly higher, and we've seen that the last couple of weeks.
A historical run.
Historical run. And you kind of have to be willing to be a little bit early. So sizing the bets, so if you're early or even wrong, it doesn't hurt you too much. So I think this is a good time to be really prudent with the risk we're taking. So domestically, we're still about neutral small caps. Like Steve and I have talked about adding some. We're a little overweight mid-cap names, and our biggest overweights are still in large cap technology companies. But I think if we were going to make a move, it might be to trim some of those big cap tech winners, move into some smaller names and some value names, I think would be the next move.
Thanks. Steve, what do you have to add?
Yeah, I agree with what Dave said about broadening. The market has been very narrow, breadth has been narrow, and it should broaden beyond areas other than large cap tech and, the Magnificent Seven. So performance and earnings of tech have been absolutely amazing. Yeah. The AI craze and, these companies are, some of them growing revenue very, very rapidly, double or tripling it in the year. I think NVIDIA was like 4 or 5 times. Wow. That's going to naturally slow over time. You can't keep getting bigger and keep that growth rate. It just doesn't work out mathematically. So I think what you want to do is look for the 493, the other stocks in the S&P 500 outside of the Magnificent Seven. And I would stick to quality because there is still uncertainty. I'm not at all surprised that we had volatility and a correction. That can be really healthy after a large run-up, and it helps reset the market and, for the future so it can go up again. I do think we face some turbulence ahead, so I would, like David, kind of stay close to home in allocation. Be overweight equity somewhat, but not too much. And I would favor domestic over international for some of the reasons that we talked about. There are just secular challenges in China and Europe and elsewhere, and the U.S. has a key advantage, which is a really robust technology industry, and that's where the growth is. I would also say expect interest rates to fall over time, and that's really positive for fixed income because it can boost bond returns, and it actually ends up helping parts of the equity market a great deal. Like small caps are very rate sensitive, as you mentioned.
That's great. Tracy, you want to round us out with bonds?
Yeah, sure. Some similar themes from the equity side. So as I commented earlier, corporate bond, the yields on the corporate bonds are extremely attractive right now. But the spreads on, the corporate spread, that additional spread is historically tight. So with that as the backdrop, I would say how we're talking about is that we don't need to reach for yield is what we call that and take unnecessary risk at this point. So we remain invested across all sectors, but our preference does lean a bit more cautious. So for example, sectors that would be, kind of fall into that category would be in broader industrials, pharmaceuticals, telecommunications. And as you said, we actually have a preference for U.S. telecommunications names as well. You can also, do it based on, the bond maturity. So maybe, you don't want to take the risk all the way out 30 years. Maybe it wants to be 10 years or 5 years. So you can do that as well. So again, we're in all sectors, but really whatever sector it's in, it's the individual credit selection that's really key here.
Great.
And that's where I think active management in the bond space is so helpful, yeah.
Yeah, I agree. Active management there, and then also for the individual investor, that conversation with their financial advisor. Well, our next question for all of you is kind of looking out a few months. And so before we do that, I want to hear from our clients. What are you expecting in the coming months? Do you think that the current financial conditions will be better or worse than future conditions? We've got few options. Today's conditions will be better than the future. Option 2, future conditions will actually be better. Number 3, maybe you think they'll be about the same. And we'll give you an out on number 4 if you're just not sure. David, Steve, Tracy, our next market and economic update will be mid-November. What is your outlook between now and then, and why?
You know, in our last market and economic update, I mentioned that this year was feeling a little 2017-ish. And what I meant by that is the market went up with pretty low volatility throughout that year. And so this year we did have a small downturn in April and just a little volatility recently, but less than 10% for most of the major indexes, and we've continued to go higher. I think we'll see some volatility between now and November, but not just because of the election. As Steve mentioned earlier, the Fed has a dual mandate: full employment and stable inflation, and they've said they view it as being kind of in balance right now, which means it could be highly economically sensitive in both directions. A weak employment report could cause concern, but so would an unexpectedly hot inflation report. We saw a couple of those in the first quarter. I mean, it seems like it was probably due to seasonal factors, but if we saw inflation reignite, that would certainly be cause for concern. And that's why, again, I've said it's a good time to stick to long-term allocations and rebalance. A lot of people are probably overweight stocks just because they've performed so well this year. It might be a good time to move a bit into bonds, but as Tracy has said, you're not getting paid a lot to take credit risk. So I really would stick to higher quality corporate bonds or maybe municipal bonds.
Great. Steve?
Sanguine, so I'm relatively optimistic, but closely watching the economy and Fed, and it feels a little odd being more optimistic than David.
I know.
Switch seats. But there's been a lot of conflicting data, and I think by the time we get to Christmas, we should have a lot more clarity on where the economy is. We expect inflation to be lower. We expect the Fed to have started cutting rates now, and that should help markets and the economy. And the job market is cooling already. But we expect it to remain solid. You may see some increase in unemployment, but we expect that to be contained and not, kind of spiral out of control, like we said. And the consumer should hold up well. Don't underestimate the American consumer.
Call out.
Yeah, and overall, I think we're at this really critical juncture because it's been 2 years since the Fed started raising rates, and they're about to begin cutting, and that should help ease a lot of the strains. So overall, positive. They're darkening clouds. I think we're in for some rough weather, but expect that to pass.
Easier if you have your seatbelt fastened. Okay, Tracy.
Yes. So coming from the corporate bond perspective, within investment grade companies, we do expect revenue or earnings growth to stay relatively strong. So that creates stable credit fundamentals in our space. So stability again. Our market has been very active, throughout the year with something that we call new issuance. So it's when our companies bring new bonds to the market, and some of that's been for mergers or acquisitions they're helping fund. They may be building a warehouse or whatnot, but we've had an exceptional amount of new issuance this year. We've also had a very active secondary trading market as well. I do think things will slow a bit as we get closer to things like the Fed's decisions, we get closer to the presidential election, because those do tend to get an uptick in some volatility, so rate volatility, spread volatility. So I do think things may slow as we get closer to those events. But overall, at these yields, demand for corporate bonds have remained very, very strong, and I don't see that changing this year.
All right. Well, let's get answers from you all on how you're feeling future compared to current conditions. 35% of you are thinking they're going to be about the same, current and future conditions lined up. 26% of you think future conditions will be better. 22% of you are not sure. And interestingly, actually, only 17% of you say that today, today's conditions are better than the future. So that's a little different, maybe.
I love the fact that Thrivent clients are an
I do
optimistic
too.
group.
I
They're
do
more
too.
optimistic.
Yeah, really interesting because it's the reverse of the broad
Michigan
national
survey or the
surveys.
conference board, yeah.
Nice. Okay, we are going to transition to our kind of favorite part of our time together, which is the live Q&A. I have a list of questions here that have been pre-submitted, and then of course you can type your questions into the Q&A box on the Zoom screen as well, and those will be fed through.
And this
to
really is live. Steve Tracy
It's
and
live.
I have no idea what's coming.
It's a very powerful position to be in. Mhm. Let's start. Actually, I like this one from Philip. Philip says, why are small businesses struggling while these large businesses seem to be doing so well?
Yeah, that's a really good question. You know, I hit on some of this earlier. Some of it, I think, is the effective rates. Smaller companies tend to be more highly leveraged. They borrow from banks more, so they often have shorter term financing. So I think they've been disproportionately affected by higher rates. Now, small companies have rallied back pretty hard the past few weeks. Keep in mind, you know, across the indexes, the Russell 2000 is the most common small cap index. Some industries like financials, real estate are overrepresented compared to the large cap indexes. So those are industries that are just inherently more rate sensitive and cyclical as well. So I think that's part of it. But there's a lot of small companies that aren't public. You know, we had Jen Wilson on here a few quarters ago who runs our private equity portfolio. And what we're seeing with the small private companies we're invested in is they're actually doing quite well. And they're getting more optimistic, in part because of the thing Tracy mentioned earlier, it's getting easier to find workers. And that was the single biggest concern that we heard from our private company investments. So, you know, overall, I think the trend is moving back towards some smaller companies.
Yeah, and I think for your traditional kind of mom and pop small business, inflation was really hard. And in particular, wages were really hard. And it was hard to find
When you
workers.
look at a mom and pop store like that, it was the first thing I would look at is real wages. As real wages turn positive, consumers get more confident, that's good for Main Street.
That's fantastic. Tracy, a question for you from Sue. And I know your answer is not going to be a recommendation, right, but just an overview. How does a bond compare to a CD? And maybe what's the difference between a bond fund and a bond?
Okay, sure. So a CD or certificate of deposit really is just a bank product. You probably already have some money at your bank, and they're just offering you a higher rate to what I call park your money or lock it in for maybe up to 18 months. So it may be an attractive yield, but it's pretty short. You also typically can't get your money out without a penalty. So that's something to consider when you do that. Where I think a bond is an interesting investment right now is maybe that attractive rate that you're seeing for a year or 18 months, you can lock that in for longer in a bond, right? Like maybe a 5-year bond, 10-year bond. And similar to equities, I've talked about holding it to maturity, but you don't have to. And in public bonds, there's a very active market. So if you need that cash, you can sell it. Now, bond prices can go up and down. So you may have an impact if you did that, if you didn't hold it to maturity. But I do think it's nice because you can lock in that rate and have the flexibility to get your money out if you need to.
Excellent.
Yeah, and as far as a bond fund, the difference is mainly that it's a broad diversified portfolio. So you're getting exposures to different companies, different industries. So your risk is lowered because you have diversification.
Across the board, that makes sense. We have a question from John, who wants to know where we see consumer spending, and also, this is an important one, I think, consumer debt going, and how will they affect the economy?
Yeah, that's an interesting question. Consumer debt is going up. You can see that on credit cards and other areas, and delinquencies are going up. But if you drill down, it's really in kind of the lower middle to lower tier of income. And we've got a little bit ahead of themselves, and we're used to spending money off of stimulus and maybe kept it. And the other thing is inflation is stretching budgets. Upper income they're doing quite well, actually.
Thank you. So we had a lot of questions. We actually had over 500 questions submitted by all of you,
Wow, that's
pre-submitted.
wonderful.
It is great. But there were a lot of them. We're going to take this one from Jody. A lot of them were around the housing market. So
Yep.
David, I know this is a topic you really care about. What's the outlook for the housing market? And then maybe I'll add one from Chris to what are mortgage interest rate expectations looking like?
Maybe I'll start with the second one. Mortgage rates are most closely tied, long-term rates, fixed mortgage rates, to the 10-year Treasury. So as that comes down, it doesn't come down one-to-one with Fed rate cuts, but as the Fed enters a rate cutting cycle, the 10-year Treasury should come down, which will bring down mortgage rates. The dynamic is with higher rates, and particularly a number of people who had locked in very low rates during the pandemic, is you weren't seeing existing homes come to the market. In a normal housing environment, the majority of the homes on the market at any given time would be existing homes, and a smaller portion would be new home construction. That's reversed now because very few homes are entering the market because you don't give up your 3% mortgage to go take out a 7% mortgage.
And it's historically low, the number of new houses
historically
on the market,
low.
particularly relative to the population.
And so people who own a home are doing great. I think I shared last time, since 2019, in the last 4 years, there's been $10 trillion of home equity appreciation. But that just means prices have gone up. So the people who don't own a home have a little bit of a double whammy in that, the prices are much higher, but also, rates are higher. So home affordability is, near all-time lows. So, but the outlook, I think it will get better. This is probably when I'm out speaking, to client groups in person, the question I get the most. It's often, my child just got married, they want to buy a home, like when are they going to be able to? And I think it will get better as rates come down and you get more supply on the market.
That's a really important point because the younger generation is not participating. One, it's hard to buy a home, but they also don't get that wealth that's built up from home equity.
Yeah.
Yeah, it's a great point, and a tough time to be trying to buy a home. Steve, keeping on the theme of debt, Dale, Mark, and actually many others have asked about the federal debt and its impact on the economy.
Yeah, it's very large right now and growing, and the main impact it's having right now is through the amount of interest that we're paying. We're paying, on a run rate about $1 trillion a year. And what that does is it crowds out other spending. It gets, it's equal to the defense budget, but it crowds out social spending and other things. And if the debt keeps growing, that'll be absolutely unsustainable. As far as markets, you saw markets have some reaction to greater than expected Treasury issuance for a little bit. You saw that last fall. Rates went up, but they kind of recovered. And the thing about debt is you look at what's happened historically, it doesn't really matter until there's this tipping point. All of a sudden, markets really, really care. And that's somewhere out in the future, but it will happen eventually if we go on this trajectory. And that's what happened, with Italy, with Greece. All of a sudden, the markets just shut them out.
Mm-hmm. How about a question here? I don't know which of the three of you want this, but is AI driving the markets now? And what's happening in AI?
But sure, they've had a very strong impact over the last year because you've seen, companies like we mentioned, like NVIDIA and the Magnificent Seven, drive it. I mean, it's driven earnings for some of the companies, but really this expectation that people will be able to monetize AI, like the Googles or the Amazons of the world. And that cohort of companies has accounted for a huge amount of the market appreciation and a very significant part of the growth in earnings. So it's been a key trend. What will be really interesting to see, how long it takes for them to actually start making money off of this. NVIDIA is, because they're a chip maker and you need chips to do this, but some of the other companies. And that's, the jury's still out. The expectation is that it will, and it'll be transformative, but we still need to see that.
And I think who the winners are may change over time. A lot of people have compared AI to the dawn of the internet. And the first winners of the internet, now we might call it bubble, were the makers of infrastructure. So it was JDS Uniphase or Cisco. These are some of these names probably people haven't thought about for a while. But the ultimate winners was like, say, an Amazon, who used the internet to transform retail. So I think as we move from most of the gainers have been on the infrastructure side, the chip makers like NVIDIA, Steve mentioned. But it'll be interesting to see how it broadens out, because that's probably the hardest thing to predict about AI. Who will the ultimate beneficiaries be?
And Yeah, and I was going to say companies, are spending a lot of money investing in it. So we're kind of monitoring like who's spending how much money. I mean, Meta, Google, Amazon spending a lot of money on this. So when do they get that return?
That's a really good point because you've seen the market start to push back on some of the spending. Like, show me the money. What when are you going to start making money off of this investment?
And we've just started hearing that in the
Yeah,
market. Like
a
for a
little
while, there was a free
skepticism.
pass, like spend as much as you want. Just maybe the last month or two, I think we've been hearing more of that.
Yeah, I've seen it pop up in headlines a little bit more as well. Gabe would like to know about his bank balance sheets, but also kind of that commercial real estate picture. I don't know, David or Tracy.
I'm happy to take it. I actually just met with our real estate team last week and talked about, we think that commercial real estate is probably kind of near a bottoming phase. So I do think it will probably get better from here, at least not dramatically worse. It's a stress. It can be a stress on bank balance sheets. It's a bigger stress for smaller banks, community banks, regional banks than it is for the J.P. Morgans of the world. But I think it's reasonably contained. We saw the bank stress of last spring. I don't think we're going to see a repeat of that, and certainly not based on commercial real estate. It's something we're keeping a very close eye on. It is worth mentioning. Thrivent has about a $10 billion commercial real estate mortgage portfolio. We are meaningfully underweight office exposure. Our biggest overweights are industrial, so like think Amazon warehouses, multifamily, given a housing shortage, apartment buildings have done well. So our office exposure is quite low at Thrivent, but something to keep an eye on.
And the expectation is that it is not a systematic threat for the whole financial industry. There'll be certain banks, there'll be pockets of stress. And the other development recently, you're starting to see people work out. Like you're starting to see buildings trade and banks take losses. That's really good because it's the process of moving on.
And the market's not unaware of this stress. So I think a lot of these bank prices, stock prices already reflect pretty low expectations around commercial real estate.
Great point. Tracy, we have a question for you from Justin. Given the current rates, how do you think about kind of investing in short-term or longer-term bonds?
Yeah, that's a great question. I think because I had mentioned we have a bit more caution right now, I would be careful on which companies you chose to invest in and how far out, right? So if you're gonna buy a 30-year bond, and that's long exposure, that's probably where you want to be very much what we call up in quality. So you're safer credits there. But at this point, I mean, we do tend to like kind of 10 years inside, 10 years, 5 years. I think that's not a nice place because of what the yield you get. You can lock it in for a certain time, but maybe not take that unnecessary risk out 30 years.
Mm-hmm. Let's stay on I think we're going to do two more questions. Let's stay on the muni bond topic for a minute. Walter asks the outlook for municipal bonds and then a short and long-term view on those same muni bonds.
I can take munis. And great name, Walter. My oldest son's name is Walter.
I wondered if you take it
I don't
just because
think
of
it's
that.
Walter Royal, but
I'd be impressed
maybe I've
if you
trained him.
did ask
It could
that.
be. I like muni bonds in this environment. I've been talking about them quite a bit when I've done other appearances. Muni bonds pay interest that's exempt from regular federal income tax. It can be exempt from state income tax too if it's a muni bond from the state you live in. So for investors in taxable accounts, particularly if you're in a higher income bracket, the after-tax yield can be quite attractive. And muni bonds typically are fairly high quality. They're issued by municipalities. They can fund particular projects like a water treatment plant or a toll road. But the default rates in the muni bond space are relatively low. They happen, but given where yields are both at an absolute level, but also munis relative to other types of bonds, I think for taxable accounts, they're particularly attractive right now.
And you probably want to say, with the economic environment, a little higher quality.
Yeah.
So that'd be like from a state or a city and avoid like a single project, single source of revenue, like a toll road or something like that.
All right, last question, and we're going to take one from Janet, though again, this was on a theme. The market is at all-time highs. Do you see a crash coming? It kind of gets at that like waiting for something to break piece.
Not a crash, no.
Maybe define of the...
I think, a bear market is down 20%, a correction 10%, a crash should be like 40 or 50%, sort of like the financial crisis. We don't see that coming. There are corporate earnings are very strong, and that's really what drives markets. over time. Like as I mentioned earlier, wouldn't be surprised to see a correction because valuations are a little rich, and that can be very healthy. But no, I don't see a crash coming.
Yeah, and even though I've been a little more pessimistic today, I think to see a crash, a 40% decline or something, you'd have to have major systemic imbalances in the economy. Like the economy was just fundamentally over-leveraged in 2007. We don't see that here. There might be little pockets here and there. The other thing is, to have a crash, you kind of have to have a recession. And we've only had 4 in the last 40 years, and we don't see a recession on the imminent horizon. So I'd be cautious. We might see a correction, even a bigger decline than that, maybe even a bear market, but I don't think we're going to see a crash.
Thank you. Thank you. Okay, we're going to move away from live Q&A. As always, thank you for the very thoughtful
was fun.
questions.
Yeah, great.
the best, most energetic part, I think. Before we go, David, would love for you to give our clients an update on how Thrivent is doing.
I would love to. We ended the year with more than 17 billion in surplus. It's actually about 17 and a half as of mid-year. So we're more than well positioned to keep our promises to our clients. Tracy gave a little overview of credit ratings earlier. We continue to have the same credit rating from Standard & Poor's. It's a AA+ rating as the U.S. government or Apple. So we can certainly be confident in our ability to keep our promises. We talked earlier about real wages, and I said our clients feel better when their wages are improving, and we see that confidence in Thrivent's financial results. We had a pretty good 2023, but 2024 is shaping up to be an even better year. And proud to say, through June 30th this year, mid-year, we've returned $261 million to our members through dividends and other non-guaranteed product elements. That's nearly double the rate of return of capital that we had back in as recently as 2021. And then, since I mentioned the S&P credit rating, that was affirmed in March, and we also have a rating from Moody's, which is the other major credit rating agency, and that was just affirmed last week. So hot off the press.
All right. Okay, well, it has become a bit of a tradition now that we end our time together with something a little lighter. We did the Christmas ornaments in December. In March, you shared an inspirational quote. We're going to close today on something more personal, too. It is clear that all three of you really take a great sense of responsibility in managing the billions of dollars of assets on behalf of our clients and Thrivent. I want to know, what do you do to unwind, relax, and maybe enjoy the hours that you're not working? David Dollett.
Well, I know this is going to seem obvious, but I have to say time with family. I mentioned Walter by name earlier. He's our oldest, and he's heading off to college in a couple weeks, so I hope I don't get teary-eyed here. But both our boys study German. I actually studied German as well. So we're heading to a family trip to Germany before Walter goes off to college, and we're actually leaving tomorrow.
Wow.
And we had scheduled the Market and Economic Update, and I wouldn't miss this for the world, so we scheduled the royal family trip around the Market and Economic Update.
That's fantastic. I'm very glad you did. We would miss you if you were not here. Steve?
Yeah, I'm trying to remember when I'm not working, what that's like. I would say live small. In other words, don't get too caught up personally in the bigger picture of what's going on in the world, and just spend time with people who are important to you. And get outside, manage stress, exercise. And then I try to remember this quote from a philosopher I think most people know, and it's, don't take life too seriously, you'll never get out of it alive. It's from Bugs Bunny, and I remember that from a long time ago, and I actually found the video clip of it, so it's real.
I didn't think of Bugs as a
the actual quote is
philosopher,
attributed to others, but the point is, don't worry too much, just enjoy the gift of life.
That's so great. Okay, Tracy, round us out here.
I have to follow up a Bugs Bunny quote. So, okay. I am obviously going to echo the family and friends time. But I would also say, just at this time of year, I just need to get outside. And it could be anything. Like, I enjoy yard work, taking my dog for a walk. I very much love cooking for family and friends. So right now it's all about grilling so that we can be outside. But I think it's so important to take a break, even if it's just a small one. You get to clear your mind, reset, you come back to work refreshed, and something I've noticed is when you come back from that downtime, you tend to have some of your best ideas.
Yeah. What a great note to end on. Well, we are at the end of our time. Thank you, David, Steve, and Tracy for taking time out of your day and sharing such rich insights with us. A reminder as we sign off, Take the time to meet with your financial advisor so that your financial strategy is up to date and that you're able to take advantage of some of these potential opportunities, of course, based on your long-term goals and your risk tolerance. It's also important to have those conversations with your financial advisor if you're feeling any sort of concern around some potential volatility in the markets. Thank you again for joining us for this market and economic update. We wish you a great summer, and as always, it's our privilege to be part of your financial journey.